Hey everyone, I'm done with showings for the day, just chilling in the office. I've just finished preparing for my open house this weekend, so I figured what else is there to do other than to make a video. I figured I could address a question I get asked a lot as a realtor. That question being, how much money do I need to put down in order to buy a house? Or how much of a down payment do I need? Now, while my answer to that question always depends on the person asking me the question, situation, I oftentimes find that people are surprised to learn that extremely low money down options are available to them, and that they don't need the commonly thought of 20 or 25% down payment. So I'd like to talk to you about one of those low money down options in this video. So just bear with me for a second. Hopefully you learned something. So let's talk about a little bit of history first. In 1934, during the Great Depression, Congress created the Federal Housing Administration, or the FHA. This is a government department in charge of one thing, and that one thing was housing. So at the time of its formation, it seemed like everyone was in default, and foreclosures were happening everywhere you turn. I wasn't there, but that's what I was told. Loans were limited to 50% of a property's market value. So for instance, if you wanted to buy a $100,000 house, the bank would only give you $50,000, meaning if you really wanted the house, you better come to the closing table with that other 50 grand. Because of this, 60% of households in America rented their homes, and the housing market was not doing so hot. To help correct this, a federally insured loan program was created that reduced lender risk and made it much easier for Americans to qualify for a loan, and thus the FHA loan program was born. So an FHA loan is designed for low to moderate income earners and allows for lower down payments and lower credit scores. Now these loans are issued by an FHA approved lender, not the actual FHA. The FHA just promises to pay a claim to your lender if you were to ever default on the loan. This type of loan, FHA loan, allows borrowers to borrow up to 96.5% of the home's value, meaning all they need is 3.5% down payment. In order to qualify, a borrower must have a credit score of 580. If they have below 580 credit score, they can still get qualified for an FHA loan. They just need to bring 10% down to the closing table. Now here's a slight catch. Since the FHA is guaranteeing your loan, you're required to pay two different kinds of mortgage insurance premiums. The first one is an upfront mortgage insurance that can either be paid at closing or it can be rolled into the loan. This amount is equal to 1.75, I believe. 1.75% of your loan is deposited into an escrow account and used if you were to ever stop paying on your loan. So it's basically backup. The second type of mortgage insurance you pay is called annual mortgage insurance. Even though it's paid monthly, the amount you pay all depends on the specifics of your loan. So like the loan amount, the length of the loan, the original loan to value ratio. Once you have paid off 20% of your loan, however, this amount disappears. Now, while I tell you all this in good faith, please remember that I'm not a mortgage lender. I'm just a real estate agent. Any specific questions about your bankability needs to be taken up with a mortgage lender, which I have several I'd be happy to put you in touch with. But for now, that's about all I got for you. Have a great weekend. Thanks for watching.